In this video, we're going to talk about Blackberry trading under the ticker symbol BB. Before the video begins, a quick heads up that not all my videos are made on the same day they're posted. If there are material events that happen afterwards, I will make a follow-up video to reflect those changes. With that being said, let's go on to today's video. Blackberry Limited is a cell phone manufacturer and retailer that makes cell phones emphasizing on security. Once a must-have for office workers and high-net-worth individuals, the company first struggled in the new era of smartphones before proving once again to the market that it is still relevant in this day and age. It has since then diversified in the Internet of Things and cybersecurity. Its appeal to the market is that it is a very well-known name in the sector and has strong brand recognition, and has also established presence amongst individual and corporate clients. It has revenue streams that become predictable with positive cash inflows, both of which are positive catalysts for the stock to thrive in the future and for those who want to make a balanced portfolio in electronics or retail sector. It is often a good company to consider due to its established presence and history, strong name recognition, and good reputation for users valuing privacy and cybersecurity. The trading volume of Blackberry has recently been 10.2 million shares, compared to an average volume of 7.6 million shares. Over the 52-week period, its price fluctuated between $7.70 and $28.77. The market cap of Blackberry is currently at $4.9 billion, compared to an enterprise value of $6.1 billion. The difference between the market cap and its enterprise value is the premium or discount financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which in turn may negatively impact its profitability, attractiveness, and even the solvency. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have more growth than another company, partially because it has a good management, stronger brand recognition, bigger following online, and so on. It is basically what is unique about this company in particular compared to other competitors in the same sector. In other words, it's not a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, which is the value the market gives to its assets once the debts are paid off. In case the company goes to liquidation, goodwill would be completely depreciated, and we would be left potentially less assets to distribute to shareholders and debt holders than the figures shown on balance sheet. In comparison to its historical price fluctuations, the stock is 0.83% higher than the 1-month low, 1.43% higher than the 3-month low, and 10.84% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment on where the stock price is likely going to lead toward, the implied volatility is 70.91%, compared to a historical volatility of 34.91%. The put-call volume ratio is currently at 0.2. It is normal for stocks to tend to have a higher put option volume than what they deserve because many institutional investors choose to hedge their exposure by buying put options. The most recent volume of options traded has been 78,000 contracts within a day, compared to the 30-day average of 59,000. Regarding the open interest, the most recent volume of open interest has been 786 million contracts, compared to a 30-day average of 776 million contracts. In terms of the open interest, the most recent volume of open interest has been 786,000 contracts, compared to a 30-day average of 776,000 contracts. In terms of its shareholder structure, institutional shareholders hold about 43% of its outstanding shares. The biggest shareholders include Alliance Asset Management, Fairfax Financial, and PrimeCap. Understanding shareholder structure is relevant to an extent because it helps to determine whether you should hold the stock long term or to view it as a short term volatility play. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long term trust from shareholders. Usually, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short term trade. This is obviously subject to a lot of exceptions since many titles are mostly held by retail investors and not institutional investors. But that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest present in the total volume, it could be a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 6.4% of the total float and 40.5% of the dark pool transactions. Now, let's take a look at the indicators. Financial indicators give us a suggestion of what the price movements are showing, and they can be used as one of the elements to determine what should be our overall approach. The oscillators are showing 2 sell, 9 neutral, and 0 buy, with an overall tendency of sell. The moving averages of the past price actions show 14 sell, 1 neutral, and 0 buy. The overall tendency from the perspective of the moving averages is the strong sell. Keep in mind that the indicators often show what the present and the past performance of the stock are, but rarely predicts accurately the future. Nevertheless, they can be relevant to determine if the timing of your trade is the right one. In terms of pivot points, which are levels of support and resistance, sprinkled in the price trends, the support levels are $6.61, $7.88, and $8.62. For the resistance levels, they are $9.64, $9.94, and $10.42. Looking at the stock over the past few sessions and weeks, it seems that the share price has been cooling down ever since its relative peaks earlier in 2021 and has been going toward the $8 support level. It would be interesting to see whether the Blackberry stock would be able to hold the line at that level, since the next support level would be around $6 or even lower. Market participants, and more specifically the retail traders, are attracted by the company because its technology and business models seem to be head and shoulders above the competitors, and this is what makes it a compelling addition in the tech or even retail portfolio. Blackberry used to be one of the major players before the smartphone era, and it has a very high brand recognition. This is why I think that the market participants are often willing to give it a chance to believe that it can succeed as long as they are encouraging signs that the company is doing well. Right now, the company seems to be having good financial results, which is one of the reasons why the stock has been enjoying some relatively comfortable price levels recently before retracing back somewhat. My opinion on the company is that I am overall bullish on the business because it seems to have a solid technology bedrock and a very strong brand recognition. The business model also means that it is stable and predictable. The valuation seems to be relatively stable as well, and this is a good news for the stock in the long term, since it means that it can predict to some degree where the shareholders are going to be a year or 2 years or longer from now. Another element to look is whether the company will begin distributing dividends at some point, because it's clearly labeled by the market as an established company. So there is some expectation that shareholders should be able to get predictable returns from it. My opinion is to allocate between 3 to 5% of your portfolio in Blackberry shares if you're looking for an established company for tech and retail portfolios. And if you're willing to give Blackberry another go, the profit target should be between $10 and $12 from where it is. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.